What's up, guys? I'm Mike from StockedUp. In this video, I'm going to be going over the art of selling diagonal spreads. So pretty much why I sell them, the pros and cons of selling them, and pretty much how to do them just completely independently. So we could see I'm going to be using an example for Procter & Gamble for a 2-week out-of-the-money put option. So to start off, I am looking at Procter & Gamble, and I am saying that I think Procter & Gamble will fall. So the whole thing and the whole way that diagonals work is you buy either a call or a put option that expires in 2 or 3 or 4 or 5 weeks. You just buy a put option or call option that's out of the money that expires in the future. And then what you do is you sell a further out-of-the-money call or a further out-of-the-money put that expires in a shorter term duration. So for example, I bought a 117 strike put option on Procter & Gamble that expires on September 13th. And then I sold a 114 strike put option that expires on Procter & Gamble that expires on September 6th. So I bought the 90 strike put option for $90 and I sold the 114 put for $15. So why did I do this, and what was my philosophy behind it? The first step when you're doing diagonals, do not trade a diagonal because you think you could get a huge rebate. Do not trade it because you are focusing on the rebate. What you should be focusing on when you're trading diagonals is looking for a good deal. All right. Right now, I'm using common sense. There's no way that this trade is guaranteed to work out, but I'm willing to take the risk that Procter & Gamble will fall by the 13th. I might be wrong, and that's why I'm selling the diagonal. But either way, whether I'm right or wrong, I win in some scenario. So, for example, the SPY right now is very weak. It's been in a channel for the past month. The trade tensions are heating up, and really, we're at a resistance mark, and there's low volume. Personally, I don't think the market's going to push through. I could be wrong, but I'm looking at Procter & Gamble. It's a value stock, and I think it's way too overextended, and implied volatility is very, very high, meaning that Procter & Gamble is going to move up or down significantly sometime soon. So, that being said, I think Procter & Gamble is going to fall. Now, I am buying the put option that expires in 2 weeks because I think it's a good deal. I think that a 117 strike put is a good deal. I like the chart on it. I like the setup, right? It's not guaranteed to work out, but I like how it looks. So I bought this for $90. And then what I did is, to protect myself, is I sold a 114 strike put that expires this week for $15. So by doing this, if I only bought the put, right? Let's say I only bought the 117 strike put, then my max risk is $90. All right? But if I sell the 114 strike put, that means my max risk is $75 because I bought something for $90 and I got $15 back. So that gives me $15 rebate right from the start. All right, so that's a pro. Now a con is that my max profit is now limited. So really what I did is I created a debit spread. So to find my max profit, you take the width of the strikes, so 117 minus 114. That gives me $3, all right? And then we have to subtract the debit I paid overall. So $3 minus 75 cents, or $70 or $75. So $300 minus $75 is $225. That's my max profit. So that's the con of selling this diagonal. Now, personally, I'm okay with a max profit of $225 on a $75 investment. That's a 300% return. Personally, I'm fine with that. So that's why I took this trade and I got the rebate of $75. All right. Now, let's say Procter & Gamble falls and it goes below 114 this week. So, and both the options expire in the money. I just made a 300% return. I'm happy. Now, let's say Procter & Gamble doesn't fall. Let's say Procter & Gamble goes up, or it goes down a little bit, or it stays sideways. Then, all right, I get to keep this $15 premium. So really, I walk away with a $15 profit on that. And then what I'm going to do is I would sell the 114 or the 115 or the 116 put on Procter & Gamble the next week. So that way, I would bring my total debit paid down even lower. So I'd bring it from 75 down to like 50 or 45 or 40. So, then again, it will limit my profit, but it will limit it to about 300%, 200%, something around there. It depends on the specific case scenario. Either way, though, I'm limiting my total risk while capping my total reward. But personally, I'm okay with a 300% profit, so it makes sense. Some people want to hold off for 500%. For me, I'm good with 300%. Now, ideally, what I want is I want Procter & Gamble to fall below, I want Procter & Gamble to fall just at $114. Because what that's going to do is it's going to let me keep my $15 credit, and then my 117 strike put would be, it would be worth over $300. Closer to $400. So that would give me a crazy profit. So it's 400. Yeah, I mean that would be an insane profit. But either way, the reason I'm selling a diagonal is because it gives me a rebate right from the start, and it protects me, and it puts me in a good scenario. I get $15 back, and my profits are capped at 300%. Like, that's awesome for me. And the thing is that I'm gonna get $15 back this week. Next week I'm gonna sell another out of the money put option, and I could get $20 back, $40 back, $50 back, or $5 back. It depends on where Procter & Gamble is, but I get 2 rebates. So I like them, but don't look for scanning, or don't look for a certain criteria for diagonal spreads. You want to find a good deal and then turn it into a diagonal spread. If you have any questions, let me know down below. But other than that, thanks for watching.